so in love with you.
Welcome back to Real Estate Mindset. Today's video is gonna be absolutely bonkers. Now, the data is in, and according to Fox News, mortgage payments are now up year over year 66%. So it's fair to say that unaffordability and interest rates right now are absolutely crippling buyers in this housing market. And today, you guys, what we're going to do is we're going to unpack an article from Fox titled Median Mortgage Payments Up 66% from a year ago at today's average interest rate. Now, obviously, a 66% increase is a straight up rug pull. It's now becoming super clear, I think, to more and more people that the Federal Reserve does not want us buying real estate right now. Obviously, right? But remember, you guys, I'm not a financial advisor. This is my personal YouTube channel, even though my bio is as a realtor, loan officer, instructor in all things real estate in Texas. And for my efforts, guys, do me a favor, like this video, subscribe if you haven't, and comment below. I absolutely love you guys for commenting. I respect your insights and greatly appreciate it. Please continue to do it. Let's jump into this article right now. And you guys, once again, 66% is astonishing. 66% is an obvious rug pull. Let's see what this article has to say, because no one else is claiming 66%. In fact, the highest data provider is claiming a 52% is the highest I have seen according to Zillow, but now that rates are higher, let's see what Fox has to say. The average rate for a 30-year fixed rate mortgage topped 6% this week for the first time since late 2008. And the latest data shows the staggering impact and combination of rising rates and elevated home prices has on affordability. After Freddie Mac reported Thursday, obviously from Fed economic data, you guys know I love those reports and I share them pretty much every Thursday unless I get overwhelmed with life. I have 4 kids, 3 jobs. I get overwhelmed all the time. I apologize. Let's continue. The average rate for the benchmark 30-year note is now at 6.02%. Realtor.com manager of economic research ran the numbers and found that the median mortgage payment is now $2,100, a 66% surge from just a year ago. So it is now clear that interest rates are as high as they were back in 2008. We also know that we are historically going into months where inventory decreases and comes off the market. I bring that up because remember, don't freak out. Buying demand has been completely crippled and will likely continue to be completely crippled regardless of inventory growth, because it's going to take some time, obviously, for inventory growth to come back to the market. I don't expect a Fed pivot until the soonest, the end of next year, but I think a lot of that is going to be dependent on values, prices, and inventory. Regardless, let's get back into the article right now. Using Realtor.com's latest list price for August of $435,000 and assuming a 20% down payment, plugged in today's mortgage rate and discovered the eye-popping payment hike over this time last year when rates were well under 3%. The median $2,100 payment does not even include additional housing costs such as homeowners association fees and property taxes, which are going to skyrocket. They called the increase significant, telling Fox Business it shows the incredible impact the interest rates, specifically mortgage rates, have had on a buyer's ability to finance a home right now. So, you guys, in other words, it's not necessarily about desirability. The fact is, millions of people want to buy right now. And in fact, millions of people would buy an overpriced house right now if they could get qualified for one. So the thing is, it's in a sense, what's going on is a liquidity crisis in mortgage lending. It's becoming harder for more people to gain access to money to buy real estate because higher payments, higher rates, and a 66 increase again. Total rug pull, right? But what's really astonishing, you guys, is again, listen to what it said. Those calculations are assuming a 20% down payment and are not including additional tax liability that will come in play because of the higher tax assessment values. So let me ask you this. Is it really going up 66%? Or is it going up even more than 66% because they have not equated in property taxes, potential HOA dues going up, homeowners insurance, things of that nature? So likely it's much higher than 66%. Can you see what I'm saying now? By the Federal Reserve does not want us to buy houses right now, which generally turns in to the best time to buy a house, but not yet, right? And that's why we're keeping an eye on the data. Let's get back into the article right now. Not only have interest rates more than doubled over the past year, but home prices also remain elevated due to low inventory. With a significant slowdown in the market and some sellers slashing their asking price, home prices are still up roughly 14% from a year ago. And obviously, Realtor.com, in my opinion, is behind the curve on that, but it is what it is. These factors are putting pressure on the housing market and causing more buyers to bow out. A slew of new economic data published earlier this month shows the sector is starting to slow considerably. Home builder sentiment about the industry plunged to the lowest level in 2 years. Buyers are retreating from the market as they cancel home sales at the fastest pace since 2020, and mortgage applications for purchases continue to slide. So I believe tightening will continue from the Federal Reserve until they start seeing enough inventory come back to the market or overwhelming political pressures. But I just don't think that they can cover up anything past midterms. Quite frankly, I don't think they're doing a good job at covering everything up. Actually, I take it back. I think they're doing a great job at covering everything up, because why isn't this stuff being reported hardcore on mainstream media, right? It is what it is. But do me a favor, comment below. Let me know if you agree with me. Again, I'm saying I believe that if we do go into months and the inventory goes down and it goes down too much, the Federal Reserve is just going to tighten even more because they do not want us to purchase homes right now. Comment below. Let me know if you agree. Let's finish out the article right now. In essence, the answer from the American homebuyer is pretty loud and clear, and that is, we are tapped out. He added, I think these rates have absolutely put a ceiling on many Americans' ability to afford a home. And I think it's particularly challenging for first-time home buyers. So here's where I want to end this video. What if you're a first-time home buyer? What do you do with this information? Now, first of all, congratulations on getting a timeout and not being able to purchase a home at the absolute peak. So the first thing is congratulations. The second thing I want you to understand is how lending works. It's basically 3 categories, and I'll briefly break down each 3 categories to give you guys some tips on how to improve your situation if you're a first-time home buyer, because most first-time home buyers need financing to buy a house, except you, Jeff M. I don't even know if you're listening anymore because you have cash. Most people aren't like that. Jeff M is spectacular. But the first thing we're going to talk about is credit, okay? So your credit score, you want in the 700s, and typically you're going to want a conventional mortgage, because the one benefit that conventional mortgages have over FHA is the mortgage insurance goes away on conventional mortgages. Your credit you want in the 700s. If it's FHA, you can have a little bit lower, but the principles of credit, I'm going to sum up by saying utilization ratio. FICO or credit scores are generally impacted heavily by derogatory information, but assuming we can put a Band-Aid on that, stop the bleeding, it's then about utilization ratio, which only applies to credit cards, not school loans, not home loans, not car loans, not personal loans, credit cards, okay? Now, in order to get an optimal credit score increase, you want each credit card to be 30% or under the credit line. If you do that, you're going to have a utilization ratio that is within the parameters to generally give you a FICO score increase. So continue to do that. One way to get a big lifeline is becoming an authorized user for someone that has a credit card in absolutely good standing. Now, the second thing about purchasing the home is you need money to do it. There's a down payment and there's closing costs. So you have to try to save even more money. One of the best ways to do that is understand how you're spending money right now. What I did, and I recommend you do, is download an app called mint.com, and I linked my bank accounts and my credit cards to this app so that I can monitor every single penny that I was spending, and I have saved, I probably saved thousands of dollars. I mean, I have saved so much money on subscriptions and food. It's ridiculous. So you guys need to save more money. Now, the third thing we're going to call income and debt, or debt to income ratio. Do the best you can at getting an additional source of income, even if you can't use it for loan qualifications. So get another job, whether it's part-time, become a solid asset at your current employer, and definitely work overtime if you can. Working overtime allows you generally to get qualified for more. But also included on that is try to get yourself completely out of debt. And I know that's hard to do and save at the same time, but try to figure out a plan to make that happen. And those are the three things. After that, you guys, you need to stay encouraged with life, and you need to become an expert in your local housing market by following the trends and figuring out what's happening. And I hope you guys can learn how to do that by watching my videos. Now, other than that, you guys, I hope you got some value from today's video. And if you're out there investing in real estate, I do wish you luck, and I hope you win.